With us around the table, Bob Elliott of Unlimited. Bob, it's good to see you.
Good to see you.
Show. Let's get straight to it. In the bond market, yields are higher. Tell us the why. Why do you think this is happening? Why are we up by close to 50 basis points on a 10-year since this Fed cut rates by 50 basis points?
I think it's the perfect instantiation of the over-easy monetary policy that the Fed is pursuing. I mean, it is very unusual for a Fed to engage in aggressive cutting in an environment where we see real GDP growing at 3.5%, where we see the GDP gap basically at its highest level in several decades. And we see asset prices as strong as they've been, spreads low. That is not the type of economy that typically would get significant easing ahead. But the Fed is committed and the direction is clear, as Chairman Powell has said.
The bias is to cut interest rates. And that goes into an election where we could see even more debt issuance. When you start to think about where yields could go, we've got numbers on the Bloomberg today, people talking up 5 all over again at T. Rowe Price. Where do you think that yield is going right now?
Well, I think when you think about what's going on with bond yields, the key risk for rising bond yields is that you start to flow through to hitting stocks, right? Because bonds are in the stocks, whether you like it or not, and that discount rate both affects stocks directly and then, of course, starts to tighten economic conditions. And so moves in this range, we could probably withstand another 30, 40 basis points of 10 years moving higher before we start to run into some concerns that that's going to create a drag on the economy. And you're starting to see a little bit, mortgage refis have come down, mortgage activity down a little bit as mortgage rates have raised on the long end. And so, get a little bit more, 40, 50 basis points, that's when we start to get the concern. But there's a long way between where we are right now and getting up to those levels.